For a long time, people believed markets move slowly. They believed price changes took weeks, months, sometimes years to fully develop. Investors imagined trends as something that gradually unfolded like a tide rolling onto the shore. But every so often, reality reminds us that markets can move in a completely different way. Sometimes the shift is not gradual. Sometimes it happens instantly. A quiet market can suddenly explode into motion, and when it does, the move feels almost unreal. That is exactly what happened here. In a matter of hours, silver made a move that shocked traders, analysts, and long-term holders alike. One moment, the market looked calm. The next moment, silver began climbing rapidly, erasing losses and pushing toward levels that had seemed distant only a short time before. Price charts that had been drifting sideways suddenly turned upward with force. The speed of the move caught many people off guard. Traders who were expecting a quiet session suddenly found themselves scrambling to understand what had just happened. But when markets move this violently, it is almost never random. Behind every sudden surge lies a catalyst. Sometimes that catalyst is economic. Sometimes it is political. Sometimes it is something deeper, something tied to the structure of the global financial system itself. And what makes silver unique is that it sits at the crossroads of several powerful forces at once. Silver is not just a precious metal, it is also an industrial commodity. It is both money and material. That dual identity means silver reacts to more triggers than almost any other asset. When inflation fears rise, silver moves. When industrial demand grows, silver moves. When geopolitical tensions appear, silver moves. And when currencies weaken, silver often moves faster than almost anything else. So when the spike happened, the immediate question became obvious. What changed so suddenly? Because something clearly had. Just hours before the surge, silver had been trading far lower. In fact, earlier in the session it had fallen to levels that worried some traders. The market had dipped sharply, and the move made some people wonder whether the recent rally might be losing momentum. But then the reversal began. Prices started climbing, slowly at first, then faster. Then suddenly the entire tone of the market shifted. Buyers stepped in aggressively. Momentum traders joined the move. Short sellers began covering positions. Within a short period of time, the metal had rallied dramatically from its earlier lows. And as the numbers updated across trading screens, one thing became clear. Silver had not just bounced, it had exploded upward. The swing between the session low and the new highs was enormous. The kind of move that reminds everyone just how volatile this market can be. The kind of move that forces traders to reassess their assumptions almost instantly. Because silver has a habit of doing exactly that. For long stretches of time, it can appear quiet and predictable. Then suddenly it erupts into motion, leaving analysts trying to explain a move that seemed impossible only hours earlier. And what makes this moment particularly interesting is that silver was not the only metal reacting. Across the broader metals complex, prices were shifting in different directions. Some metals were climbing sharply, others were holding steady. One in particular had dipped slightly, while the others surged higher. That divergence caught the attention of many market watchers. Because usually precious metals tend to move together when a major catalyst appears. When they start separating from one another, it often signals that something deeper is happening beneath the surface. Meanwhile, other markets were moving as well. Currencies were shifting, energy prices were falling rapidly, equity markets were pushing higher. Each of these moves might seem unrelated at first glance, but in reality, they are all connected pieces of a much larger puzzle. To understand why silver suddenly surged, you have to look at the entire system. You have to look at currencies, commodities, geopolitics, and market psychology all at once. Because silver does not live in isolation. It lives inside the global financial machine. And when something inside that machine changes suddenly, silver often reacts before most people fully understand what just happened. In this case, the trigger appears to be tied to geopolitical developments that began unfolding rapidly. Signals started emerging that a major conflict situation might be evolving faster than expected. The possibility that tensions could ease sooner than anticipated sent ripples through global markets almost immediately. And when markets sense that uncertainty might decrease, capital begins repositioning instantly. Energy markets reacted first. Oil prices dropped sharply as traders began adjusting expectations about supply disruptions and shipping risks. A drop in energy costs can ripple through the global economy because energy is the foundation of transportation, manufacturing, and industrial production. At the same time, currency markets began shifting as well. The world's reserve currency weakened slightly during the session. That move may not sound dramatic, but even small changes in currency strength can have powerful effects on commodity prices. Precious metals in particular often react strongly when the dollar moves. When the dollar weakens, metals priced in that currency tend to rise, and that dynamic appeared to play a role here. But the currency move alone does not fully explain the magnitude of silver's surge. Something else was happening beneath the surface. Another important factor involved changes in trading conditions within the futures markets. Margins, the capital traders must post to hold positions, had recently been adjusted. Lower margins can attract more speculative participation because they reduce the upfront cost required to trade large contracts. When margins fall, leverage becomes easier. And when leverage becomes easier, markets can move faster. Speculators who had been sitting on the sidelines suddenly have the ability to enter positions more aggressively. That influx of new trading activity can amplify price swings dramatically, especially in a market like silver, where liquidity can sometimes be thinner than in other major assets. So imagine several forces hitting the market at the same time: geopolitical headlines shifting rapidly, energy prices falling, the dollar weakening, trading margins changing, speculators returning. All of these elements combine to create the perfect environment for volatility, and silver thrives in volatility. The metal has always had a reputation for dramatic price swings. Over the decades, it has experienced some of the most explosive rallies in commodity market history. Periods of calm can last for months, or even years, but when momentum finally builds, the moves can be breathtaking. For investors who follow silver closely, days like this are a reminder of why the metal attracts such passionate supporters. Because silver is not simply another commodity. For thousands of years, it has served as money. Empires minted coins from it. Civilizations stored wealth in it. Traders used it to settle debts, long before modern currencies existed. Even today, despite the dominance of paper money and digital transactions, silver retains that ancient monetary identity. At the same time, modern technology has given silver a new role. It is now one of the most important industrial metals in the world. Solar panels rely on it. Electronics rely on it. Medical technologies rely on it. Advanced manufacturing relies on it. Every year, more industries discover new uses for silver because of its unmatched electrical conductivity and antimicrobial properties. This dual role, both monetary and industrial, creates a unique supply and demand dynamic. When economic growth accelerates, industrial demand rises. When financial instability grows, monetary demand rises. Either way, silver can benefit. And that is why so many analysts believe the long-term fundamentals for silver remain incredibly strong. For years, the world has been consuming more silver than it produces. Mining supply has struggled to keep pace with industrial demand. Recycling helps fill part of the gap, but structural deficits have appeared repeatedly in the market. That means the global supply of available silver can become tight surprisingly quickly when investment demand suddenly increases. Which brings us back to the current moment. Because what we witnessed during this sudden spike may not simply be a random price move. It may be a signal that the silver market remains extremely sensitive to global developments. A signal that volatility is far from over. And perhaps most importantly, a signal that the broader bull market in precious metals may still have powerful momentum behind it. For many investors watching the move unfold, the message was clear. Silver is not finished yet. Not even close. And if the forces currently shaping the global economy continue intensifying, currency instability, geopolitical tension, structural supply deficits, then today's sudden surge might only be a preview of much larger moves still waiting ahead. Because throughout history, when silver finally awakens, it rarely moves quietly. It moves fast. And sometimes it moves all at once. What makes this moment even more fascinating is that silver's spike did not happen in isolation. When you zoom out and look at the broader financial system, you begin to see a pattern forming. Markets across the world are moving in ways that suggest something deeper is unfolding beneath the surface. Because silver rarely moves this aggressively unless multiple forces are pushing it at the same time, think about the structure of the global economy for a moment. Nearly everything in modern finance revolves around confidence. Confidence in currencies, confidence in governments, confidence in markets functioning normally. When that confidence remains strong, money flows predictably through the system. Stocks rise steadily, bonds behave normally, commodities trade within relatively stable ranges. But when that confidence begins to shift even slightly, the system starts to behave differently. Investors begin asking questions, they start reassessing risk, and they start moving capital into assets that have historically protected wealth during uncertain times. For thousands of years, precious metals have played that role. Long before modern banking systems existed, people used silver as a store of value. Entire economies were built around silver coinage. Merchants traded across continents using silver as a universal medium of exchange. Even today, despite the rise of digital currencies and electronic payment systems, that historical memory still influences how investors behave during times of uncertainty. When doubt creeps into the financial system, precious metals often become a refuge, and silver, in particular, has a reputation for explosive reactions once momentum begins building. That is why the sudden spike we are witnessing deserves attention, because moves like this often mark the beginning of something larger. One of the most important factors driving the silver market today is the growing tension between supply and demand. For years, industrial consumption of silver has been rising steadily. New technologies rely heavily on silver because of its unmatched electrical conductivity and durability. Solar energy production alone has become one of the biggest drivers of silver demand. Every solar panel requires small but significant amounts of silver to function efficiently. As countries race to expand renewable energy infrastructure, the demand for silver continues to climb, but supply has not kept pace. Mining production has struggled to increase at the same rate as industrial consumption. Many silver mines are actually byproducts of other mining operations, meaning silver production often depends on the economics of entirely different metals. When base metal mining slows down, silver supply can tighten unexpectedly. That imbalance between supply and demand creates a fragile equilibrium. Under normal conditions, recycling and existing inventories help stabilize the market. But when investment demand suddenly surges, like it often does during periods of financial uncertainty, the available supply can disappear quickly. This is where silver becomes particularly volatile, because unlike many other commodities, the physical market for silver is relatively small compared to the scale of global financial markets. A sudden influx of investment capital can push prices dramatically higher in a short period of time, and that appears to be exactly what is starting to happen again. At the same time, currency markets are adding another layer of complexity. The global financial system is built on fiat currencies, money that derives its value from trust rather than physical backing. As long as people believe in the stability of those currencies, the system functions smoothly. But when inflation rises, or when governments expand money supplies rapidly, investors begin looking for assets that cannot be created at will. Silver is one of those assets. Unlike paper currencies, silver cannot simply be printed into existence. It must be mined, refined, and physically produced. That limitation gives silver an inherent scarcity that paper money does not possess. Over the past several years, monetary expansion around the world has been unprecedented. Trillions of dollars equivalent have entered the global economy through stimulus programs, central bank policies, and debt financing. While those measures helped stabilize economies during difficult periods, they also increased concerns about long-term currency stability. As a result, many investors have quietly been accumulating precious metals. Some prefer gold because of its long-standing reputation as a monetary reserve asset. Others are drawn to silver because of its affordability and its potential for larger percentage gains during bull markets. Historically, silver has often outperformed gold during the later stages of precious metal rallies. Once investor enthusiasm builds and momentum spreads through the market, silver's smaller market size allows prices to accelerate rapidly. This phenomenon has played out repeatedly across decades of market history. There have been periods where silver remained quiet for years while gold steadily climbed, but once silver finally joined the rally, it often moved faster and farther than most people expected. The recent spike may be an early signal that such a phase is beginning again. Another factor that cannot be ignored is the role of speculation. Modern markets operate at incredible speed. Algorithmic trading systems, hedge funds, and leveraged futures positions can amplify price movements dramatically. When momentum begins building in a commodity like silver, these players often accelerate the move. Short sellers who had bet against rising prices suddenly find themselves under pressure. As prices climb, they are forced to close their positions by buying back contracts, which pushes the price even higher. That process can create powerful feedback loops where each upward move triggers additional buying. These cascades can happen incredibly quickly. Sometimes the market moves so fast that analysts only understand the full picture after the rally has already begun. That may be exactly what we are witnessing now. But beyond the short-term trading dynamics, there is a much larger story unfolding in the background. The global economic landscape is changing, trade patterns are shifting, supply chains are being restructured. Geopolitical tensions are influencing energy markets and international commerce in ways that were unimaginable only a decade ago. All of these changes create uncertainty, and uncertainty often drives investors toward tangible assets. Silver sits at the intersection of these forces. It benefits from industrial growth, it benefits from financial uncertainty, and it benefits from currency weakness. Few assets possess that combination of drivers simultaneously. That is why many long-term observers believe silver could be entering a completely new phase of its market cycle. In past decades, silver frequently struggled to maintain higher price levels for long periods of time. After dramatic rallies, the metal would often retreat back toward previous ranges. But the current environment may be different. Industrial demand is far stronger today than it was during previous cycles. Renewable energy technologies alone are creating structural demand that did not exist in earlier decades. At the same time, the global monetary system is facing pressures that many economists believe could reshape financial markets for years to come. If those trends continue, the baseline price for silver could shift upward permanently. Some analysts already believe that the market has entered a new paradigm where previous support levels may never be seen again. Levels that once seemed expensive may soon appear cheap in hindsight. That possibility is part of what makes the recent spike so important, because sudden moves often signal that markets are beginning to price in a future that most people have not fully recognized yet. For investors watching the charts, the message is becoming increasingly clear. Silver remains one of the most reactive assets in the financial world. It responds quickly to geopolitical developments. It responds to currency movements. It responds to industrial demand. And when multiple forces align at once, its price can move with extraordinary speed. The rally we are witnessing may still experience pullbacks and volatility along the way. That has always been part of silver's nature. Sharp corrections are common in this market. But corrections do not necessarily mean the broader trend is finished. Sometimes they are simply pauses before the next major move. If the structural forces driving silver continue strengthening, tight supply, growing industrial demand, and rising investment interest, then the current rally could extend far beyond what most observers expect, and that is what makes the present moment so intriguing. Because when silver begins accelerating, history shows that it rarely stops quietly. Instead, it often climbs in waves, each surge drawing more attention, more investors, and more momentum. And once that cycle begins feeding on itself, the metal can reach levels that once seemed impossible. The recent spike may be only the beginning of that story. And so here we are watching a market that can change direction in an instant. One moment, silver looks quiet, even weak, and the next moment, it erupts higher with a move that forces everyone to stop and pay attention. That's the nature of this metal. It has always been volatile, always been sensitive to the forces shaping the global economy. And history shows that when silver finally begins to move, it rarely does so in small steps. The spike we just witnessed may end up being remembered as just another short-term surge, or it could be the early signal of something much bigger unfolding beneath the surface. Because the truth is, the forces driving this market, currency shifts, geopolitical tensions, industrial demand, and tightening supply, are still very much in play. And if those forces continue building the way many analysts believe they will, then the real story for silver might only be getting started. So now the real question becomes simple. Was this sudden spike just a temporary reaction? Or was it the first glimpse of the next major move that could redefine where silver trades in the years ahead? Only time will answer that, but one thing is certain, this market is far from finished, and the next move could come faster than anyone expects. If you found this breakdown valuable, make sure to like the video and subscribe so you don't miss the next major update on silver and the global markets. And let me know your thoughts in the comments below. Do you think silver's next move will be even bigger?